Imagine a billionaire CEO builds a utopian, off-grid tech city on a private island for his 10,000 employees. To ensure total independence, he completely cuts them off from the global banking system. Within a week, the island is on the brink of total collapse. Here is how they were forced to reinvent money from scratch. Before the employees arrived, the CEO was on the island alone. In economics, this is called the Robinson Crusoe Economy. He caught his own food and built his own shelter. Because he was completely self-sufficient, money didn't exist. There was no one to trade with. But when the employees arrived, everything broke. A software engineer who wanted a coffee tried to pay the barista by writing lines of code. But the barista didn't need code. She needed a mechanic to fix her car. This is the first stage of economic history, the barter economy. It creates a massive logistical nightmare known as the double coincidence of wants. You have to find someone who has exactly what you want and wants exactly what you have. Enter the island's chief financial officer. To save the city from starving, she introduces a new system. She selects highly valuable physical solid-state batteries and declares them the island's universal trading tool. They have just invented commodity money. To work as money, the textbook says these batteries must serve three primary functions. First, a medium of exchange. Everyone agrees to accept them. Second, a measure of value. A coffee costs 1 battery, a laptop costs 50. Third, a store of value. Unlike trading fresh fruit that rots, you can bury these batteries for a year and they still hold their worth. According to the classic qualities of money, the CFO's batteries are perfect. They are durable, portable, and easily divisible. But as the island's economy booms, physically carrying around heavy metal batteries becomes a massive burden. So, the CFO builds a highly secure central vault. Workers deposit their physical batteries, and in return, the CFO gives them a lightweight paper receipt. This is the birth of representative money. The paper itself is worthless, but it is 100% backed by the physical commodity sitting in the vault. Eventually, the island's population explodes. The vault cannot hold enough batteries to back all the paper needed for trade. So, the CEO makes a drastic move. He officially decrees that the paper notes are now the island's legal tender, the only acceptable way to pay rent and taxes. The battery backing is gone. This is fiat money. It has no intrinsic value. It only has value by government order. This is exactly how the US dollar and global currencies work today. Finally, citizens start depositing their fiat paper into the island's new commercial bank for safekeeping. The bank realizes not everyone withdraws their money at the same time, so they keep a fraction of the deposits in reserve and lend the rest out to businesses. This is commercial bank money. Through fractional reserve banking, the bank legally expands the money supply without printing a single new note. Physical cash vanishes. The economy becomes a complex network of demand deposits. It requires the strict, precise tracking of millions of digital entries across a central ledger. The island has successfully transitioned entirely to digital money, but now a much bigger threat looms. By freely lending out digital money, they've accidentally flooded the island with too much cash. Prices are skyrocketing. To save the city from economic collapse, the CFO must invent a central bank, define the M1 and M2 money supply, and master the dangerous art of monetary policy. And that is exactly what we will break down in part 2. If this helped you understand the DNA of money, subscribe to the Banker's Desk. See you in the boardroom next week.